Hello everyone and a very warm welcome to today's stock markets update for Friday, March the 28th, 2025. It was blood on the street the whole week. So is the dead cat bounce over? Yay or nay? In our previous webcast, we thought it would be a nay. However, it looks like it's going to be a yay. However, there is a tricky way to make this dead cat bounce last a little longer, and I'm going to share that with you. However, it is not the end of the world. Okay, we are not going to die. This is all still a-okay. And I wanted to share this slide because it shows lots of ones and zeros, because we are going to assess the health of the semiconductors. And I think the semiconductors are in a very interesting position that most likely are going to be a canary in the coal mine. We think that the S&P 500 is currently in a smaller fourth wave of a larger third wave, and that fourth wave can take a little bit longer than anticipated. The NASDAQ and NASDAQ 100 should be in this larger fourth wave, and the semiconductors should already be in this A wave. And I'll share that with you in a moment. So let's assess the charts, starting with the semiconductors. This is the daily chart of the semiconductors that I've shared with you for a long time. And it's been quite a overlapping mess since the July 2024 high. So far, we only have 3 waves lower since that all-time high. This is wave A, this is wave B, and then wave C should now be underway for a 5-wave decline. The 5th wave should ideally target somewhere around 4150 to about 3850. So we're getting awfully close. So how is this then going to resolve itself? And I'm going to show you 3 different options with a very nice, elegant, preferred option that would allow for closure of this gap at 5700. But first, the bigger picture. Elliott Wave tracks mass sentiment. The yearly candles are the best mass sentiment you can get for the Elliott Wave. 5-second charts do not track mass sentiment because less and less people participate in the stock market on such a small time frame. Most people are not actively engaged at all in the stock market. They go about their daily lives and might check in every quarter or every month when they get their 401k returns or their investment or their brokerage account returns, and then they make decisions. It is, of course, private investors, traders, and retail traders that are more engaged, but most people are not. So to capture these quarterly, monthly, semi-annual decisions, yearly charts are, of course, the best. You start off with the yearly and then you zoom in. And as you can see here, we have most likely completed a cycle 3 at the 2024 high. So we have cycle 1 here into 2000, ABC lower for cycle 2, 1, 2, 1, 2, 3, 4, 3, 4, 5. And you can see down years are counted as 4th and 2nd waves. Okay, all of them. Here we have a nice ABC lower. If I would print this on a closing basis, then you would of course see a very nice impulse higher. Okay. And as you can see here, primary 4 went even below the 50% retrace of all of primary 3. On a yearly closing basis, it got awfully close to the 38.2% retrace. So here I've shown you cycle 4. Somehow it disappeared on the chart. Cycle 4 right there. Anywhere ideally between the 23.6 and 38.2% retrace. Most likely 38.2 at about 37.30. But as we saw from the primary 4, we can even go to about 30,000 or 3,040 to 3,050 on a little bit further 50% retrace. We're not here to predict the future because we can't. So we start off with standard Fibonacci based impulse, fill itself in. But again, most likely we are in this cycle 4, and after 4 eventually comes 5. Now please take into consideration that cycle 2 lasted 9 years. So cycle 4 should last a few years as well. Just sitting through this is maybe not necessarily the best approach, but to each their own. If we then look at the monthly chart, we get 12 times more candles because we have, of course, 12 months per year. Starting in 1994, you can clearly see the cycle 1, the cycle 2, the primary 3 and 4, and the cycle 3 top. This counts to us the best way. If we then look at the current decline since the 2024 high, a ABC would target somewhere around 3850, 3900. Okay, 3850, 3900, which matches, of course, very well with the price target zone we have here on the daily chart. We're currently at 4285, so another 200-point decline should be expected. That could then be wave C. Once again, we're going to go back here. We have the cycle 3-wave high here in July of 2024. 5 waves lower, 3 waves back up, 5 waves lower. Okay, so far so good. So how can we resolve this in an elegant manner? So we cannot predict the future, but we can share the possible paths the market is now going to take. Okay, and all possible paths for now point to most likely a little bit more downside and then a lot of upside. And how much upside, that remains to be seen. Most likely at a minimum 5,000, 5,700 would be really ideal, and new all-time highs is least favored. So I'm going to start here with the cycle 3 top, the A, the B, and the C. That then gives us 3 waves lower. Right? That's what we got. 3 waves lower. A, B, 1, 2, 3, 4, 5, C. And as you know from the Elliott wave, after 3 waves lower, expect at least 3 waves back up. Now this can then morph in either a triangle or a flat. A flat is a 3, 3, 5. And in a flat, the B wave will challenge the start of the A wave. The A wave here is then 3 waves. The B wave will be 3 waves. The C wave will be 5 waves. Okay? Alternatively, this is all of cycle 4, and we're going to go to new all-time highs for cycle 5. Well, we know cycle 2 lasted 9 years, so cycle 4 lasting 12 months, which is a 12th of in length of a cycle 2, seems quite odd. Making this into a flat correction will get us most likely into late 2026, and we might now see for the remainder of the year a big fat bounce. All right, because primary A lasted, of course, from here to here. Okay, so primary B should last all the way into the end of the year. Wouldn't surprise us at all. And then we get primary C lower, which is a degree higher than what we've seen so far. These 5 waves lower here have lasted so far about 4 months. So you do it a degree higher, it's going to last at least most likely double to triple as long, 8 to 12 months. So the B wave into the end of 2025, the C wave into the end of 2026, then you have a 2.5 year corrective pattern. 2.5 years aligns, of course, with 9 years of the cycle 2. That I can live with. So the alternative is that we're going to go to all-time highs. I don't think so. We're going to look higher. Alternatively, we're going to look higher. After, first, a little bit lower. Now, there is another potential, and this is, of course, a very bearish potential, that it wasn't a A wave and a B wave, right? But that it is a wave 1 and a wave 2, and we're now going to see a wave 3, okay? The wave 3 here will then go to about the low 3000s. So now we're setting up for wave 1 of wave 3 to complete. Again, pretty soon here at around 4150 plus or minus 100. Then we're going to get a bounce to about 5000 plus or minus 100. Okay, 5000 plus or minus 100. I hope you can read my handwriting. And then we'll see a 5-wave decline as well. So here we're looking for about 5000. Okay, the previous we were looking for at least 5700 to potential new all-time highs. That's the least favorite new all-time highs. So all of them suggest a little bit more downside and then a lot of upside. And after a lot of upside, downside again. That's really the general path. Even after a potential new all-time high, we should still see once again a lot of downside, because then the cycle 5 will have topped. And yes, we can of course see a B wave as well, right? We don't know yet, sorry, if we're going to get just 5,700 or if we're going to get 6,200. That I don't know. I'm just showing you the potential path, and this is, in my humble opinion, the most likely path, because after 3 waves lower, expect at least 3 waves back up. And according to the yearly and the monthly chart, I would say must, but we are most likely in a cycle 4 wave. And a cycle 4 wave, or any fourth wave, is often a flat. Just like primary 4 was a large flat wave. And I'll show you that for the S&P 500. Actually, I might just show you that right here, right now, using the Dow Jones. You see this one, this was a primary 4. So you had A, B, C, all right, for A, B, C for B. So we believe the semiconductors are now either in this wave or just in this wave. A, B, C, 5 waves lower. See that? So after 3 waves lower, expect at least 3 waves back up. And here we got another 3 waves lower. And you can see how long the primary 4th wave lasted for the Dow Jones, 2 years. So a cycle 4th wave for the semiconductors should at least last that long as well, right? You really see the similarities in price pattern. So are we now in this A wave or already in this A wave? To be determined. For now, we say we are in this A wave. Okay? Sorry. For a Dow perspective, we're in this A wave. Then we're going to get that. Anyways, you see really what we're looking for the semiconductors using historical patterns for the Dow Jones. So those are the 3 options I'm looking for. With the preferred one, I like it, is a flat cycle 4 with soon a very large B wave to occur after a little bit more downside. Moving on to the NASDAQ 100. Well, the 1, 2, 3, 4, 5 as a leading diagonal is off the table. Yesterday, we did say we were looking lower for about 90,400, 90,700. And boy, we got more than we bargained for. But we knew we would have to look a little bit lower. That was our preferred scenario. Remember the NASDAQ 1 hourly chart? Well, this is of course now off the table. This cannot be a wave 4 anymore. Low. So we're going to look here for a low anywhere between 17,200 and I would say 19,000. Okay, somewhere around there, because we don't know the length of the C wave just yet. Is it going to extend? Yes or no? I don't know. Depends on how bearish the market is. So was this just a wave 1? Are we going to see a wave 2, a 3, a 4, and a 5 to complete the larger C wave of wave 4? Very possible. But I do want to point out that C waves do not have to be equal to A waves. They can be shorter. I have seen 0.382 lengths. Okay, it is all very possible. Just look at this rally here, for example. Okay, and just look at this rally here. Here we had extended C wave. Okay, here we had a very brief C wave. Okay, so C waves don't always have to be the longest wave. They can also be shorter. Now, I do want to point out a very tricky scenario, that of a irregular expanded flat wave B. The wave B would then top here at around 21,000. We're currently in the wave B that should bottom out at around 19,000 plus or minus 100. It will become irregular, and then we get the C wave higher for the wave B, and then the final C wave lower for this larger wave 4, which would bottom somewhere around, I would say, 17,000 to 18,000, somewhere around there. And then we have retraced the entire rally that started in August last year, and that's quite normal for a 1 degree higher 4th wave. Okay, because then of course the top here was all of the intermediate wave 5 of major 3 right there, and then we have major 4. So this is a very possible scenario. It would wrong foot most. Remember, we're starting to see potential positive divergence on the MACD. Now if we go back in time, and all we need to do is go to about 2022 and see what happened to the NASDAQ 100 if we had positive divergence on the MACD. All right, let's go here to the first positive divergence that we can find. It can last a while, as you can see, from here, and then we got the big fat rally, okay? Every time it was pretty that was pretty lucrative, honestly, from here to there. Yes, we had downside, but honestly, the downside was not as much as the upside potential. Then, of course, we had positive divergence here. Massive rally. And then, of course, we had positive divergence here, which eventually led, of course, to the new bull run, though late 2023 we almost revisited those lows in October, November. But I do want to point out that positive divergence can last a while. It's a condition, but oftentimes does lead to even substantial bounces, if not full-on bull markets. So a bounce, therefore, seems highly likely. Also here we had a irregular flat B wave. So this was then wave A, this was wave B, this was wave C. Similar here, we had an A wave, a B wave, and a C wave. All right, this was wave A, wave B, wave C. The B wave went below the start of the A wave. The B wave went just to the start of the A wave. So would it be too much to ask to then say, well, that might now happen here as well? Okay, this might happen here as well. So this is a potential 123.6% extension of wave A measured from the top of wave A to about 18,900. And then the C wave, if it's 161.8% extension, targets exactly the 61.8% extension 21. All right. So please keep this tricky one in mind. It would match pretty well with the semiconductors bottoming out pretty soon over the next 2-3 days. All right. That would not surprise me the latest. And then a lot of people will think that we're going to ratchet down all the way, of course, to the 17,000s, and instead we're going to go higher. This is then, of course, the bigger picture chart. And again, I cannot count 5 waves up from the 2020 low, the COVID low. I cannot count 1, 2, 3, 4, 5, right? That would be a proper impulse. Now, also, this week's high barely registers as a B wave. Okay, we got one tiny little up week. It could be it really could, but it does not look right from a proportionality perspective. If the semiconductors are indeed going to rally pretty soon for that larger flat wave, that will of course make the other indexes rally as well. I know that we should not compare apples to oranges, that each index is on its own. But we do also know that if the semiconductors start to rally, NASDAQ 100 will rally with it, and then often the S&P 500. Why can we not treat every index the same? It's because the S&P 500 is the broader economy, the NASDAQ 100 is the technology sector of that broader economy, and the semiconductors are, of course, the chip sector of the technology sector of the broader economy. So that's why they cannot be regarded as one and the same. And clearly you could see the wave counts are quite different. So here we are. And this is why I say we could still see something like this and then this. All right. And then, of course, this rally would match with that of the larger B wave in the semiconductors. And then this decline would match with the larger C wave for the semiconductors as well. Okay. So please keep that in mind. And even if the semiconductors bottom here, that could still be wave A, and then we have another wave B and another wave C, okay? So take it day by day. Just because we've done 3 waves lower at some point doesn't mean that the correction is over, because after 3 waves lower, always expect at least 3 waves back up, because we can get a more protracted correction if the market decides it needs to do so based on new information that becomes available. Once again, the current decline is still within a normal bull market cycle and bull market behavior. All right, let's move on to the S&P 500. Also here, the leading diagonal first wave is off the table. We're not going to address it anymore. Then we just switch over to the potential irregular flat B wave, targeting anywhere between 5,900 and 6,000 for a standard normal 61.8% retrace of the previous decline. We've completed this larger diagonal of the August low, 1, 2, 3, 4, 5. We made a new all-time high, so this cannot be a wave 1 and a wave 2. NASDAQ is possible, but not for the S&P 500. We did 5 waves decline that subdivided to 9 waves. Now we did 3 waves up. So again, an irregular B wave and then 5 waves higher for this one. And then the C wave would not surprise me. And the C wave, once again, can target anywhere between 51.70 and about 53.50. Very normal retrace level. Can we go there at once? Yes, we can. So then how would we resolve that? This would be wave 1. Okay. This would be wave 2. Then we get wave 3 and 4. Okay, 3 and 4. And that's and 5, of course. Okay, that's it. It could really happen quite quickly. But I would not be surprised if we see this irregular B wave happen and then this C wave to about 5,900, 6,000, and then the decline. Last but not least, the B wave could have already bottomed. I know this is complex. We're right at the 76.4% retrace. This is all I'm going to give. This is a lower odds, and it is still a possibility. And then again, we're targeting around 5,900 plus minus 100. Okay, I'm not going to give it too much wiggle room based on the other indexes, but it is still very possible. And again, just like I showed you for the NASDAQ 100, the bigger picture wise, remember in a standard impulse, the third of the third wave targets, of course, 100% extension. The fourth wave targets the 61.8% extension. And then the fifth wave targets 138.2 to 161.8. Again, so far, we've barely done the normal B wave retracement. I think we just reached the 38.2%. It barely registers on the weekly chart. So that leaves me really thinking that we're going to see this irregular expanded flat B wave and then the C wave. And again, as long as we stay above 5,100, it's all nice and dandy. Very normal for a 1 degree higher fourth wave to retrace the prior 1 degree lower fifth wave. Very normal, okay? So no, the world's not going to end. The semiconductors clearly show the world's not going to end. If the world's going to end, don't worry about it. Your money will be useless. We're all going to die. And that's not going to happen, all right? It's not going to happen. So far, so good. Standard Fibonacci-based impulse pattern and a big fat correction was due once you complete 3 waves up, meaning red wave 3. Okay, so then we move on to the Dow Jones. The Dow Jones also suggests that we're not done yet, that we're still in this red wave 4, nothing out of the ordinary. And then the IWM, however, could have topped for a very larger fifth wave. Okay, that's all I'm going to say about it. So what do other people have to say? Can we somehow reconcile our work with that of others? And of course, we're not going to look at Joe Schmo on X. We're going to look at those that are really pundits and experts within their work. This is work done by David Settle, who's a great analyst, and he's just looked at corrections since, I believe, the 2009 low, where price remained under the 200-day moving average. So we have 1, 2, 3, 4, 5, 6 corrections, 2022, 20, etc. And on average, during these 6 corrections, the S&P 500 was 110 days below the 200-day simple moving average, and it bottomed out on average 15% below it. So far, we've only spent 13 days below it and about 4%. Okay, so we have more to go in time and price if history tends to repeat itself. Okay, so still only corrections. None of these led to the end of the world. Okay, neither does the Elliott Wave suggest this is the end of the world of a much larger top, except of course for the semiconductors. But even the semiconductors still need a cycle 5. Now, this is work done by CryptoCon. CryptoCon is, of course, a guy in the cryptocurrency world who's done fantastic cycle analysis that I have adapted and adopted to my work as well. And it's been really spot on. So here's looked at all the years since 1920s high, and he's found that there's a 25-year cycle with a 9-year pause in between each cycle. Again, history doesn't have to repeat itself, but it often rhymes, and he's found that we are currently in a similar situation as the 1990s and the 1950s. Okay, so far so good, and it also suggests that we are not going to top until 28 to potentially 1934. I agree. If we look at, of course, our bigger picture wave count, it still looks like we have a lot of topping to do before we really reach the end. And this is really a third-party confirmation. This is somebody who is not an expert in the S&P 500, but really on cryptos, all he posts is about cryptos, but this was a long time coming, as he wrote. And this is his observation. It doesn't mean it's correct. We can only work with the data at hand, but this is what the past has shown. And I think it's a fantastic relationship between time and price and how it cycles and where we currently are. It definitely matches with the Elliott wave count. ATM snipes, what he's seeing, a larger fourth wave. The SPY potentially as low as 500. Oh, it's pretty close to our 5170 level, so somewhere around 500, that region, as you can see here. And then he expects a larger three-wave move back up, akin to for the semiconductors, and then, of course, a five-wave decline to complete a larger fourth wave. Please note that he thinks the S&P 500 is in this larger third wave, similar to that of the NASDAQ 100. It's possible. The bottom line is that also he thinks we're getting now in the next final leg lower, which is very possible to target 5170s ASAP. I still think that sneaky irregular B-wave flat would be something really nice. This is work by Xenia. This she posted a week ago. Also here we have A, B, C and a target zone of, again, 5100 to about 5400. Okay, 5380 to be exact and 5117. Same as we're seeing, exactly the same, and that's a wave 4, and then it's still a wave 5 into the 7000s. Okay, so far, nothing out of the ordinary. And she also has, of course, invalidation levels, and we do not want to see price go, I believe, around 4900. If we go below 4900, it really starts to increase the odds that we're not going to see 7000. And then last but not least, work by friends at ElliottWaveTrader.net. Also here we can be in this larger fourth wave down to 5170. All right, all roads lead to Rome. 5170, I've seen it on this webcast now 3, 4, 5, 6, 7 times. And I think this is still a very good roadmap. And ADO suggests a much lower high for this wave 5, somewhere in the mid to high 6000s. But that's okay, it still points to the same path. All right. Yes, the correction can last a lot longer. So please be aware we can get whipsawed with the irregular B wave based on where the semiconductors are currently. And that would then suggest that we should see a very strong rally really soon. But I have zero indications of a bottom is in place. So we can't position ourselves for that just yet. We need to see, of course, reversal signs. For now, I think it is prudent to look lower. And once we get a very good bottom signal, then I think it's going to be very prudent to look for much higher prices. So around 6,000 for the S&P 500 at the minimum, around 5,000 on the semiconductors for a minimum. The NASDAQ 100 should then target somewhere around 21,000, and the Dow Jones, I'm be looking for somewhere around 47,500. That's all I have for today. Take care. All next week.